Welcome to the deep dive. This is where we take the information you send us, dig into it, and pull out what really matters. Think of it as a shortcut through the noise.
And today, we've got a big one. Alphabet Inc.'s Form 10Q. This is their official filing with the SEC for the first quarter of 2025.
Right, the 10Q. So for anyone maybe not familiar, this thing is packed, isn't it?
Oh, absolutely. You get the core financial statements, balance sheets, income statements, cash flow, plus management's take on things, accounting details, risks. It's all in there.
Okay, so our mission today isn't to get lost in every single number. It's more about spotting the key trends, right? Understanding how Alphabet actually performed in early 2025 and maybe where things seem to be headed.
Exactly. Cut through to the core story.
All right, let's get started. So the big picture. Financially, how did Q1 2025 look for Alphabet?
Well, it looks pretty strong.
Yeah.
Revenue came in at $90.2 billion.
$90.2 billion. Okay, how's that compare?
That's a solid 12% increase compared to the same time last year, Q1 2024, which was $80.5 billion.
12% growth. Okay.
And interestingly, if you look at it in constant currency, sort of taking out the effect of exchange rate changes, that growth was actually a bit higher, 14%.
14%. That constant currency number often tells a slightly clearer story about the underlying business, doesn't it?
It does, yeah. Gives you a better sense of the real operational momentum.
But the number that really caught my eye was the profit. That seemed significant.
You're absolutely right. Net income just soared. It hit $34.5 billion for the quarter.
$34.5 billion from what, last year?
From $23.7 billion in Q1 2024. So that's a jump of 46%. Really remarkable.
46%. Wow. And that flows through to earnings per share, I assume?
Directly. Diluted EPS, earnings per share, climbed 49%. It went up to $2.81 from $1.89 last year.
Okay. Those are some seriously impressive growth figures. What's driving that big boost in profitability? Is it just the revenue growth or something else?
It's a combination. Looking at operating income helps. That grew 20%, hitting $30.6 billion this quarter, compared to $25.5 billion a year ago.
And the margin, did that improve too?
It did. The operating margin expanded. It went from 32% last year to 34% this quarter. So, yeah, they're not just making more money. They seem to be doing it more efficiently, too.
So better cost control, perhaps. Keeping expenses in check.
That definitely looks like part of the story. Their cost of revenues, so the direct cost of generating that income, it increased, but only by 8%.
Ah, okay. Slower than the 12% revenue growth.
Exactly. And that difference helps fatten up the margins. Those costs include things like TAC traffic acquisition costs, what they pay partners, but also content costs, infrastructure depreciation, some employee costs.
Got it. And what about the other big bucket of costs? Operating expenses, like R&D, sales.
Those also grew slower than revenue, up 9% overall. If you break it down, R&D saw a pretty significant increase.
Investing in the future there.
Seems like it. Sales and marketing actually dipped slightly, which is interesting. And general and administrative costs were up. But yeah, that R&D bump probably signals continued focus on innovation, maybe especially around AI, given everything that's happening there.
Makes sense. Okay, so strong top line, even stronger bottom line, helped by efficiency. Let's peel back the onion a bit. How did the different parts of Alphabet perform? Starting with the giant, Google services.
Right, Google services. This is the core search, YouTube, Android, ad subscriptions, all that. Revenue there was up 10%, hitting $77.3 billion.
Still huge growth on a massive base.
It is. And operating income for services was even stronger, up 17% to $32.7 billion. Now, inside services, the advertising piece is, of course, critical.
Yeah, let's break that down. How did search do?
Google Search and their other related ad revenues increased by a healthy $4.5 billion. What's interesting is how paid clicks were up 2%, but the cost per click, what advertisers pay each time someone clicks, was up 7%.
So slightly more clicks, but advertisers are paying noticeably more for each one.
That's the story, yeah. Suggests continued strong demand for those search ads.
Okay. And what about YouTube ads, another big engine?
YouTube ads also performed well. Revenue climbed by $837 million. The report says this was driven by both direct response advertising, ads trying to get you to click or buy now, and also brand advertising. Yeah. So pretty broad strength there.
Good to see. What about the Google network, the ads on partner sites?
That one was actually down slightly. Revenue dipped by $157 million.
Oh, why was that?
It looks like the number of ad impressions served on partner sites decreased by 5%, although the cost per impression did go up by 4%.
Fewer ads shown, but each one cost a bit more? Could be a shift in focus, maybe? Or changes in partner inventory?
Could be. Hard to say definitively from just this, but it's a slight counterpoint to the strength in search and YouTube ads.
Okay, so search and YouTube still powering ahead. What about the non-ad parts of Google services, subscriptions, devices?
Yeah, that category, Google subscriptions, platforms, and devices, saw a nice revenue increase too, up $1.6 billion.
Yeah, what's driving that mainly?
Primarily subscription growth. Things like YouTube Premium, YouTube Music, and also Google One, their cloud storage subscription.
Right, so those recurring revenue streams are becoming more meaningful. Okay, let's shift gears to Google Cloud. This has been the big growth story everyone's watching, especially for profitability.
And Q1 delivered on that front.
Yeah.
Google Cloud revenue surged 28%, reaching $12.3 billion.
28%. That's accelerating, isn't it?
It is. And maybe even more importantly, operating income really took off.
Yeah.
It went from $900 million profit last year to $2.2 billion this quarter.
Wow, 2.2 billion in operating income from cloud. That's a significant milestone. It's really becoming a profit engine now, not just a growth area.
Absolutely. It's a major turnaround story playing out. The narrative is shifting. Both parts of cloud seem to be contributing to Google Cloud Platform, which is their infrastructure services, and Google Workspace, the productivity tools like Gmail and Docs.
Great to see that investment paying off. Now, what about the other bets, the moonshots?
Right. The more experimental ventures, revenue there was actually down a little to $450 million, and the operating loss widened slightly to $1.2 billion.
Still losing money, which isn't unexpected for R&D heavy bets, I guess.
Exactly. It's a mix of things, healthcare tech like Verily, maybe Waymo, internet services things, not big enough to report on their own. Losses are pretty typical here as they invest for the long term.
Okay. And the last piece is alphabet level activities. What falls under that?
This category covers costs and sometimes income that aren't tied to a specific segment. The operating loss here grew to $3.0 billion.
$3 billion. What's included?
It's corporate overhead, some cross-company R&D, especially AI-focused work they mentioned, philanthropy, but also things like severance costs and charges for reducing office space. We also book hedging gains or losses here. It was $260 million gain this quarter, up from $72 million last year.
Okay, so a mix of central costs and some financial items. Given all these moving parts, let's look at some other key financial details. You mentioned their cash earlier.
Yeah, their main cash and marketable securities position was pretty stable, around $95 billion. Still a huge war chest.
But you also noted something about non-marketable securities.
Right. This was interesting. Their holdings of non-marketable securities, think investments in private companies, things not easily traded, jumped quite a bit, from about $38 billion up to $51 billion.
That's a big leap. What's behind that?
Well, digging into the notes, it seems mostly driven by increases in the estimated value of their private equity stakes. The carrying value of those non-marketable equity holdings was $48.6 billion at quarter end, and they actually remeasured or revalued $25 billion worth of these during the quarter.
Revalued based on what? These aren't public stocks.
Mostly using what accountants call level 2 inputs, so not direct market prices, but based on things like recent funding rounds for similar companies or other observable data. There's some estimation, but it's based on market signals.
Okay, so their private investments are being marked up significantly. Does that show up anywhere else?
Oh, yes. It's a huge driver behind another line item. Other income expense, net or OI&E. That line absolutely exploded. It went from $2.8 billion in income last year to $11.2 billion this quarter.
$11.2 billion. What caused such a massive swing?
The report explicitly calls out an $8 billion unrealized gain on those non-marketable equity securities we were just talking about, linked to one specific private company investment.
$8 billion. Unrealized. So like paper gains.
Exactly. It's like the value of your house going up on Zillow. It boosts your net worth on paper, boosts the income statement, but you haven't actually sold it or received cash. It's a valuation change.
Still, an $8 billion markup is significant. Must be a promising investment.
Seems likely. That OI&E line also included about $416 million in gains from some convertible notes they held being converted. But the big story there is definitely that unrealized equity gain.
Important distinction, though unrealized isn't cash flow. Speaking of cash flow, what about their spending, capital expenditures?
CapEx was up significantly. They spent $17.2 billion in Q1 2025.
$17.2 billion. Up from what?
Up from $12.0 billion in Q1 2024. So a pretty big ramp up in spending.
Where's that money going?
Mostly into technical infrastructure. Servers, network gear, building out data centers. The report ties it to supporting overall growth and, again, the big push into AI. You need a lot of computing power for that.
Makes sense. And they also made a big strategic move on the acquisition front, didn't they?
They did. Announced in March a deal to buy Wiz.
Wiz, the cloud security company.
That's the one. For a hefty price tag. $32 billion in cash.
32 billion, that's a huge bet.
Massive. It's not expected to close until 2026, and the plan is for Wiz to become part of Google Cloud. It really signals their ambition to be a top player in cloud security.
Okay, so big investments in infrastructure, AI, and now a huge acquisition in cloud security. What about returning cash to shareholders? Any news there?
Yep, continuing on that front too. They declared a quarterly dividend of Ryando 21 cents per share in April.
That's an increase, right?
It is, yeah, a 5% bump from the previous $1.20. And they kept buying back their own stock pretty aggressively. Repurchased $15.3 billion worth of shares in Q1.
15 billion just in buybacks in one quarter.
And there's more to come. In April, they authorized another $70 billion for future buybacks. That's on top of the nearly $30 billion they still had left from the previous authorization.
Wow. So they're generating enormous amounts of cash and returning a significant chunk through dividends and buybacks, even while investing heavily.
That's the picture, yes. Very strong cash generation funding both investment and returns.
One last detail, Google Cloud's backlog. What does it tell us?
Right, the remaining performance obligations, or RPO, basically contracted future revenue that hasn't been recognized yet. As of March 31st, that's set at $92.4 billion for Google Cloud.
$92 billion in contracted future revenue for cloud. That's quite a pipeline.
It's substantial.
Yeah.
And they expect to recognize about 55% of that, so over $50 billion within the next 2 years. It provides pretty good visibility into future cloud revenue growth.
Okay, that's a lot of positive momentum. But these 10Q filings also include warnings, right? Forward-looking statements, risk factors. We should probably touch on those.
Absolutely essential. You always have to read the fine print. The document is full of forward-looking statements, management's expectations about future growth, margins, AI investments, and so on.
But they come with caveats.
Big ones. They explicitly state these are based on current beliefs and are subject to risks and uncertainties that could make actual results very different. Don't take predictions as guarantees.
And what were some of the key risks they highlighted this time? Anything stand out?
Regulatory scrutiny remains a major theme. Antitrust investigations, rules like the Digital Markets Act in Europe, these are ongoing concerns. Privacy issues, IP claims are also mentioned.
Yeah, the legal battles seem constant. Any specific updates?
They mention the ongoing cases with the European Commission shopping, Android, AdSense, and the DOJ cases in the U.S. covering search and ad tech. Plus, the Epic Games lawsuit outcome regarding Google Play, which they're appealing.
A lot of legal fronts.
Indeed. And importantly, for many of these big legal matters, they state they can't even estimate the potential financial loss right now.
Yeah.
That just highlights the uncertainty involved. These things could potentially force major changes to their business down the road.
Right. So a strong quarter financially, but definite clouds on the horizon, particularly on the regulatory side.
That's a good way to put it. The current performance is impressive, but the operating environment is complex and carries risks.
Okay. Let's try to wrap this up. If we boil it all down, what are the key takeaways from this deep dive into Alphabet's Q1 2025?
Well, first, really strong financial performance, solid revenue growth, significantly boosted net income and margins. Both Google services and, crucially, Google Cloud contributed. Cloud's profitability jump is a major development.
Right. And lots of investment happening.
Definitely. Huge spending on infrastructure, clearly linked to AI and cloud growth. The massive Wiz acquisition underlines the strategic focus on cloud security. And alongside all that investment, they're still returning billions to shareholders via dividends and buybacks.
So it's a snapshot of a company firing on, well, most cylinders financially, while placing big bets on the future.
Pretty much. But, as we just discussed, you have to layer on the context of those forward-looking statement warnings and the significant ongoing legal and regulatory challenges. It's not a simple, straight path ahead.
It really shows how much valuable insight is buried in these filings if you take the time to connect the dots.
It does. And you see these broader tech themes playing out the resilience of digital ads, the critical importance and now profitability of cloud, the massive race in AI. It's all reflected in these numbers.
So for you, our listeners, as you digest all this, maybe a few things to ponder. What does that really strong Google Cloud growth, coupled with the heavy AI infrastructure spending, tell you about Alphabet's main priorities for the next few years?
And how might that relentless regulatory pressure, especially around ads and app stores, eventually reshape how they actually do business and make money? Could it fundamentally alter things long term?
Also, that huge $8 billion unrealized gain. What could that signal? Is it just a one-off valuation bump? Or does it hint at a future strategic move, maybe an acquisition target or a deeper partnership?
These are the kinds of questions that take you beyond just the reported numbers. The 10Q gives you the data points, but thinking critically about the why and what's next is key.
Absolutely. If you want to dig even deeper, the full 10Q is available on the SEC's EDGR database. It's worth exploring. Thanks for joining us on this deep dive.
Yeah, thanks for listening. Keep questioning, keep analyzing.